man, are we live? Give me a yes in the chat because it is FOMC day. I am in a dingy hotel room with horrible Wi-Fi, but that will not stop us from seeing what happens with the FOMC, monitoring the charts, and a whole lot more. Smash up likes, guys, if you appreciate this content, even when I'm homeless on the road, because we need to make some money on crypto. We need to understand, where is this market going? If you've not watched my video from earlier today, you will know that we are in a very, very precarious position right now where Bitcoin does not want to go below this yellow line, below 27,700, because if we lose that, those targets of 26,000, 25,000 start to come back. If we get some positive news, we could be breaking through 30,000 and beyond. Markets are of course pricing in that we will be seeing that 25 base point rate hike. That's pretty much a certainty. Anything outside of that, expect some crazy moves in the market, guys. Like, it'll literally be insane. But what more reasonably the market is expecting is, will we start to see the Fed talk about pausing rate hikes? Now, there has been one spanner in the works, and that was that the ADP jobs figure came out just a few hours ago, and it came in hot, much higher than expected, showing that more jobs were still being created. Remember, we get the non-farm payrolls on Friday. Chances are that Jerome Powell had an early peek of that before deciding his FOMC meeting decision today. And all to play for. Look, on the other side, you've got the banks collapsing. What is Jerome Powell going to do? Guys, I'm going to need your support in the chat as well. Stu, I can see you're sick here. If you guys cannot hear me, if you cannot see my screen, if it's lagging, you've got to let me know. I do suggest when it comes to the press conference, make sure you've got it open on your own side as well so you can hear Jerome Powell speaking clearly, just in case mine starts to lag or buffer as well. Okay, so let's see who we got in here, guys. I'm going to smash up the likes as I read through your comments. Music Addiction, good to see you. Barney, evening all, smash up the likes. We've got Pico Rally, we got Kadir, good to see you, buddy, hope you're well. Fazil, Nabil, lots of familiar faces. Reckless Danny again. Wakaz, good to see you. Omar, good to see you again. Altaf, good to see you again. Doug, hope you're well. Carlos, Nabil, Brandon, Stu is not feeling too great. Alex, we got Doug here as well. Neil's in here, loads of people jumping in. Carlos is watching on vacation. What a legend. What a legend Carlos is, listening to Jerome Powell drone on during his vacation. And that's because he understands the importance. He understands the importance that once we get to the point where we're pausing, this market really can U-turn. And it can U-turn sharply. And that's the thing. All investors right now are trying to time this U-turn. When is the Fed going to pause? And when are they going to start cutting rates? That's when the market's going to go crazy. So what you can see here now is, over this last hourly candle here, Bitcoin is getting a reaction. Now, if you guys are experienced traders, take advantage of the links in the description, ijaz.uk/BYBIT, ijaz.uk/Binance, some amazing exchanges there which you can use to trade these moves. But be very, very careful. If you're not experienced, make sure it's a tiny amount of money. But you're seeing the traders getting excited in the lead up to the announcement. Then often you see a dump, and then you see crazy volatility heading into the press conference, okay? So these are the normal patterns we get on FOMC day. Cool. I'm just going to test the TV now, and then we're 5 minutes away from getting that interest rate decision, so I will be pulling that up as well. Let's go test if my TV action is working here. You guys let me know if I'm a good techie and if this is working.
I mean, I think at some point, if the Fed does not cut rates and the market's pricing in these cuts, I think the 10-year will struggle to rally a lot more. But, you know, we're talking so much about the Fed reaction function. It's the economic outlook that's extremely uncertain. In fact, when we talk about the curve, I think of what's priced in as a bimodal distribution. There's a view of the soft landing camp that the Fed is on.
Guys, can you hear that okay? Let me know in the comments, because we're going to need that when it comes to the price. Okay, you can't hear me. Can you hear me now? See? You guys are legends. Can you hear me now? Can you hear me now? What I was waffling on about was that if Jerome Powell does 50 basis points today, which is not going to happen, guys, unless he wants to lose his job. If he does 50 basis points, the market is not going to be happy, right? Already you've got prominent figures like Elon Musk and various others saying, just cut rates. What are you doing? Like, stop, right? So that's the pressure he's going to be under now. Even doing this 25 basis points, a lot of prominent figures are saying do not do that, okay? Hopefully you guys can hear me now. I can hear the yeses in the comments. Thank you so much. Be responsive in that chat. If anything gets lagging, if anything's messing up, let me know. I'm going to keep my eye on this chat because this hotel is useless. Okay, absolutely useless. Right, so again, very important. CPI figures next week. Okay, non-farm payrolls on Friday. CPI figures next week. So my prediction is we'll get 25 base points. Markets, the traders will do their thing. It'll get a bit volatile, and markets will be okay with that. Then we've got to listen to Jerome Powell. If he says hawkish things, if he says things like there's still more work to be done, I expect further ongoing rate hikes and wording like this, no bueno, not good for the markets. If he gives us clue about pausing, if he says our work is done, we don't want to tie after, maybe he's going to do something like that. That's what we're looking for. What we don't want is him to come out gung-ho, loads more to do, off we go. Okay? Now, guys, can one or two of you let me know in the chat, when I played the TV, could you hear the audio in the TV? Could you hear the TV? Because remember, that's good. Let's make sure to walk down with the monitor. People looking at me weird, but I got to bring you guys the updates, man. You guys can't not have this chart on this big screen, right? You can't not have it on FOMC day. So we've got a 5-minute chart, left-hand side Bitcoin, right-hand side is the NASDAQ, okay? We're going to monitor this going into the FMC meeting. We're going to see the traders play their games. Be very, very careful unless you're experienced. But what we want to see is we want to get that 25 base points, no surprises, and then we want to go move into the press conference, okay? Very, very important. Okay, so let's start refreshing. I'm going to start refreshing here. You guys refresh as well on your side, because obviously you're going to have better Wi-Fi than me, because apparently I'm in a third world country known as the UK, who can't seem to get their Wi-Fi infrastructure sorted. So that's what we're going to do. I'm going to refresh. You refresh as well. Put it in the chats if you get it first. Yeah, it's bad, man. I mean, I might as well be in the middle of flipping desert. Useless. And that's when you pay the premium for the best internet as well. You're like, what's the point? Junebug says JP is the king of sitting on the fence. There's more to do. Yeah, but he's in a really tricky one. Even if you listen to the experts on like Bloomberg and CNBC, like he's in a really tricky one now where people are not happy with him, right? So I'm going to just refresh now. We're 1 minute away according to my watch, and I do want to get this up, and hopefully the internet doesn't die on us. It'd be so funny if it does. Well, not funny for you, not funny for me, but someone will find it funny, I guess. We'll keep refreshing. And let's find out, will we get that 25 basis points? Then we can move on to the press conference. Let's just see, do we get that 25 basis points? No surprises. If we get 0, can you imagine? This market will be absolutely crazy. Because look, he's killing the banks. I mean, he could do 0. It's not out of the realms of possibility. Just nobody expects him to. Okay, so now we're on the hour according to me. So I refresh. Nothing yet. Let me know if you guys get it first. Like I said, I'm in a third world country known as the UK. Don't come here. Can't even get Wi-Fi right. Still refreshing, nothing to be seen. I'm just looking at here at Bloomberg. Bloomberg haven't got it yet as well. They're breaking the news now on Bloomberg. No, they're not. They've not got it yet either. I'm still refreshing. 25 basis points, guys. It's 25 basis points. Let me pull up the TV for you guys. There you go. FOMC hikes rates by 25 basis points. Okay, no surprise there. As expected, let's now monitor the charts to see what the charts are doing. And markets are happy. Markets are taking this positively because they didn't get shunned with 50 basis points. But this is traders, okay? Let the traders do their thing. We're going to see how it settles in. 25 basis points is okay, but we expected that. We're now at 5 to 5.25 on the Fed funds rate. Now we need to understand, what does he say? Is this the last one, or is there further ongoing rate hikes? Let's refresh the report here. Let's see if we can go into the PDF statement. Because sometimes they say something like ongoing, right? He's not said the word ongoing, which is great. So let's keep going here. Committee decided to raise the target range for the Fed funds rate to 5 to 5.25. The committee will closely monitor incoming information and assess the implications in determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time. The committee will take into account the cumulative tightening, so all the stuff we've already done, the lags with Monetary Policy Effects Committee. In addition, the committee will continue reducing its holding of treasuries. Interesting. They did not say ongoing rate hikes. They normally say ongoing. I'm just going to search that one more time. Ongoing. No ongoing. Okay, so I can't see them saying ongoing. and that's a positive sign. Normally, sometimes they say this, we expect ongoing rate hikes. That's one early positive we can see here from the FOMC statement. Let's see what else they say here. Committee's assessments will take into account a wide range of information. That's all standard, okay? That's all standard, nothing to worry about. Traders are doing their thing now here on the 5-minute chart. Let's notch that down to the 1-minute chart because we can. Let's pop it to the 1-minute chart and let's see what Bloomberg are saying. Let's see what the suits are saying over there.
You see the move there, much stronger euro, much weaker dollar off the back of some of this, reflecting the move lower in yields. So just to summarise what Mike McKee just went through, third paragraph in a statement, that one line in the last meeting we're all talking about for so long, the committee anticipates that some additional policy firming may be appropriate. Replaced with this, so I'll read through the quote again for you. The committee will closely monitor incoming information and assess the implications for monetary policy in determining the extent to which...
Exactly what I said. He just picked up the same thing as us. They took out the ongoing bit, which is good.
Will take into account the cumulative tightening of monetary policy.
The ones with a prepared statement, they're all going to be there, and they're going to be carefully written, to say the least. Someone that's written those statements... Michael Gapin joins us now. Economics.
Okay, so we'll come over to the news shortly if they have anything interesting to say, but for now, look at the markets. Absolutely crazy right now. You can see some Bitcoin rotating now slightly to the downside here on the minute chart. Minute chart, you're going to get this craziness, right? Do expect it. Normally, after you get the interest rate, you get craziness, and then you go into the FOMC press conference. Will Jerome Powell give us any clues that we could be pausing? Okay, let's take a look at what the market's expecting now, because that's going to be important. Let's jump on over to the markets to see what they're pricing in. So now 84% are pricing in for the next meeting, which is June the 14th, that we should be pausing. Sorry, they've priced in a cut at the moment. I think this is wrong. Let's see how they update this. But so far, this is what this is showing us, guys. 84% of the market expects us to go down by 25 basis points at the next meeting. Could we get a cut at the next meeting? Look, I think that's wishful thinking. I think a pause will be good, and then we'll take it from there. Iyad, why are you saying no sound? Do you guys have no sound? Let me know if you have no sound. Otherwise, I will carry on. Look, I think you got levels. I think you should hear me having some sound, even though I'm in the middle of the sticks somewhere with no Wi-Fi. Make me mad. Right, so this is where Bitcoin is. Let's take a look at the key levels and spend some time analyzing this now. So a lot of people are kind of getting caught up on this Bitcoin chart and getting, kind of, let's call it worried, right? Well, should they be worried? Well, the reality is we're in a bit of a stalemate now. So if you haven't watched my video from earlier, we failed the higher high at 31, right? We ran up to 31 on this occasion, and here we wicked all the way up to just shy of 30,000 and we got rejected again. Okay? Similarly to the downside, the bears managed to wick us all the way down to just under 27,000, but then this time they couldn't. They wicked us all the way down to 27,700. So on the highs, the bulls are failing, on the lows, the bears are failing, and we go and consolidate into a triangle pattern. Yes, if you watched my video earlier, you will see that we are running into this triangle pattern, which has to decide a direction. Now, the positive for the bulls is the EMA ribbon acts as support. Can we bounce? Can we break from this triangle and work our way towards 31? And then eventually the price target from this would be 32.5. That's going to be a very, very important move here on Bitcoin. Now, if we want to take the positives, you've got to look at this and say, hang on, Bitcoin's done phenomenally well. It wasn't long ago we were sitting at 19,000 down here, right? If we take a look at this chart, it wasn't long ago that we went down here to 19,500. In fact, it feels like ages ago, but it was the 10th of March. And now on the 3rd of May, we are sitting here having bounced off 27,700 and held it as support, right? That is good. That is really good, okay? We've got to feel positive about that. So when you look at this chart, that's what's important. I don't want you to feel worried. If there is a pullback, this is the chart you want to look at. It's the weekly chart, okay? The weekly chart gives you a good framework. So you know what? If it wants to pull back, I'm not going to lose any sleep if it pulls back to the EMA ribbon. That's now sitting at 26,000 because the EMA ribbon is going higher and higher. So before, whereas a couple of weeks ago, if we wanted to pull back, the EMA ribbon is sitting at 25,000. Now the EMA ribbon starts to creep in at 26,000. So we're going to get that support soon. Thinking about it. Okay, so the longer the bears take to thrust to the downside, the more time we spend above our weekly EMA ribbon. Bitcoin is consolidating, bulls are gaining strength, holders are now in profit. You start to speak to people who are in a lot of pain. Those that were DCAing are now returning into decent levels of profit. The only ones who are really struggling right now are those who bought loads above 30,000 and never DCA'd when Bitcoin went lower, right? Those are the ones that are struggling right now. The rest are in a decent cadence where they manage to DCA. A lot of people have managed to get themselves a 30, 40k cost basis, and so their portfolio is slightly green, if not slightly red, and they're doing alright, right? They're at least within touching distance of feeling green and feeling positive. So that selling pressure you're getting at 15,000, at those painful levels down there, it's not the same now. The dynamics of the holders has fundamentally changed. Okay? So I'm going to switch over to Jerome Powell when he does come on. That's going to be in the next 20 or so minutes. If you guys have any questions, feel free to throw them in the chat. We can look at some of your favorite projects. We can do some TA, or if you have any questions on the macros, do that. Let me know if you've worked through my TA course, guys. Let me know in the comments. Have you worked through my TA course? Ijaz.uk/TA. If you have, let me know in the comments. What did you like about it? What would you like to see in a version 2, like a more advanced TA course? What type of topics would you like to see? I'm also working on another course, free. It's going to be the same thing, Skillshare. It's going to be completely free for you guys, not charging you thousands of dollars for these courses, which is about building a masterful portfolio. How do you actually build from ground up, just starting in do, how do you take profits, how do you DCA, when's the best time to DCA, all these strategies will all be in one place for you, and that'll be free as well, okay? Jerome said, talk to me. You touching any alts right now? Not just yet. I'm not nibbling on any alts just yet. I feel like we're still quite elevated. So for me, I'm not nibbling actively on any alts in particular. But I will be. Like if Bitcoin wants to come to 26, not only will I be topping up on Bitcoin around that level and nibbling more, but altcoins as well. Like particularly layer 1 solutions. For me, layer 1 solutions, when that money rotates across, like people are sleeping on alts because Bitcoin's having its moment, but eventually the alts will come. I have belief in the altcoins. I mean, if you look at this here on the daily chart, this is Bitcoin dominance, right? If you haven't seen my threads on Twitter, make sure you go look at those as well. There's some top data in there on some of this. So let me just jump over to the weekly actually. So I'm going to show you this. Okay, look at what Bitcoin dominance is. I put this all in the Twitter thread. I'll try and link that up for you guys. We're trying to break here through 48. Now, if it can break through 48, we could see an explosion in Bitcoin dominance. And this could be a Bitcoin-led move. And in that period, altcoins, everyone will be like, oh, altcoins are rubbish. That's okay. They'll have its moment. Okay, because the last time the dominance broke through 48 in the ascendancy to the upside was all the way back in August of 2018. But then it went on a crazy run. It went up to 73%, guys, on Bitcoin dominance. Bitcoin was the thing. It was running in that period. Okay, it was going through its bull market. And in that period, you're going to wish you ate your veg. You're going to wish that you topped up your Bitcoin and your Ethereum, right? Then afterwards, when this happens, when it starts to fall, then your altcoins will start to pick up. Okay, that's the rotational pattern you get. Guys, don't forget to smash up the likes. Really does help more people find this live stream. Let's see what else for questions you guys have. Let's see what questions you have. Dana said, anyway, 2024 is accumulating. 2025 will be bull year. XRP Falcon says, smash up the likes, ladies and gentlemen. I agree with that. I agree with that sentiment. Hey, can you please address Pepe? Of course I can. I'm heavily bought in. I want to know if it will reach 110 again. Well, first of all, I don't have a magic crystal ball, but what I can do is look at the charts. And with meme coins, okay, it's all about holding your nerve, right, in these things. These things are crazy. Like, to try to do technical analysis on this to any deep extent is pointless. But one thing I do know for sure is the way you want to play this is you want to set alerts like I've done there. You can set yourself alert, right click, okay, and click on add alert, and you set yourself alert. So what I did here was, at the peak where it got rejected, I set alert. And what I then did was I put on the EMA ribbon, if I show you here, it's not showing me the daily EMA ribbon now, it's not loading, but at the daily EMA ribbon, where the ribbon starts, I put another line. And the reason for that is, if you want to add to these kinds of positions, a lot of people are asking, how do I jump into a meme coin? It's hard. It's not easy, because once the momentum comes in, it's hard to catch it. But your best bet is wait for pullbacks. Loads of people FOMO in here because that's when everybody's talking about it. But then, look at that, right? Look at that pullback here to 40%, right? When nobody's talking about it, that's when you get a discount. And then when it goes crazy and break up through here, then everyone's going to be buying again. But you don't want to do that. You want to be buying in support. That's the key. Look at the discount you're getting now. And it's the same project. They could do something again the next couple of days and the hype will go crazy again. right? So if you are trading meme coins, of course, be very, very careful. Make sure you've eaten your veg. Make sure you're only investing what you're willing to lose. These are crazy projects. There's no fundamentals behind them, right? There's no fundamentals behind them. There's no guarantee they're not scams. So you know what you're getting into. Play it safe. Don't put crazy amounts in. And eat your veg. Very important. Chris Locke, what do you think about sell in May and go away? Look, this is one of those old things I remember from traditional finance. Yes, you do get an element of that. People do that, sell in May and go away. But you know, you get anomalies, right? It can happen. Like, you just look at the chart and you see, oh, some years it works, other years it doesn't. I wouldn't buy too much into it. Like, the reality of markets is, if Jerome Powell decides to do an interest rate cut in May, then then everything's going to skyrocket. So it doesn't make sense. It works until it doesn't, right? It's one of those kinds of patterns. More important is, of course, look at the fundamentals, look at where we're trending, and look at what we're doing today, which is this. When Satoshi Nakamoto created in 2008, right? From that time to now, we know the exact monetary policy from Bitcoin all the way up to the year 2140, right? We know the monetary policy. There's no interest rate hikes, there's no this, there's no that. We know the monetary policy. We know every time there's going to be a halving, and we know exactly what happens to the block rewards, and we know exactly what the max supply is. But with the Fed, we don't know. Every month we have to wait for an FOMC meeting. Every month, how much is being printed this month? Are you going to change the interest rate? Like, this is why fiat currencies are horrible, right? Now, unfortunately, we need to watch the FOMC meeting. Unfortunately, we need to listen to Jerome Powell. Not because we think he knows it all. No, we think the fiat's not going to work. But we have to listen to him right now because Bitcoin, at this stage, is being correlated to a risk-on asset. Bitcoin is a function of liquidity. So when there's liquidity in the market, Bitcoin does well. Okay, very, very important. All right, let's now jump into the short time frames again. Markets are stabilizing a little bit here. Bitcoin at 28,600. Not a major move. Had a little bit of a move up when the data came out, as you'd expect. Look at that big wick, guys. Within a minute, people get wrecked. Look at that. Look at that. If you're not experienced, you get wrecked here. In fact, because I've got the premium trading view, I'm going to drop it down to a second. Why is it not working? I have it. Oh, they've violated me. I have premium. They've violated me. I do have the second chart. I don't know why it's not working. But anyway, when you look at the second chart, you'll see that literally that whole minute is like seconds. And that's what I remember from traditional finance. When I was at traditional finance, it doesn't matter how good you were. It's about how quickly your trading computer would execute. They would pay millions and millions of dollars just to make sure their fiber lines were connected closer to the exchange so you could execute quicker. Right? It was insane. Like, I remember I'd sit there with like 10 monitors, and if at a critical time one of your computers went wrong, like 10 people, you press a button, like 10 people would come and replace your computer immediately. Boom, 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 boom. Get back to trading. Right? It's insane. So yeah, you've got to be very, very careful in here. Don't trade with these. You got a bunch of algorithms all trading these. The bots all trading these as well. Just chill out. Just chill out in these moments. Let the institutions do their thing. Don't get liquidated. Right? Don't be the the feeding bed for those guys. Nope. Be patient, be poised, and look for your positions in a smart way. Right, let's see what the television is saying.
Article. And with what we see from the Fed, where are we going to be in June and on to the December meeting?
Well, thank you for having me on the show, Tom. I guess a couple of points. I do think in the statement today, as I think others expected, they did adjust the language, and so they definitely want to have the option not to hike at the June meeting by including that language on the extent. But I do think this is a committee that will, and we'll see this from the chair today, I imagine pretty soon, is going to emphasize they're not declaring mission accomplished. Inflation is way too high. And certainly this will be, I think, sold, and they believe that it's a pause, and they're going to do what it takes. Now, looking ahead, I have written and do believe that, under a plausible scenario that the Fed has laid out in the projections, which I broadly agree with, inflation a year from now could be running in the twos, but probably not near 2.0, probably north of 2.5, maybe closer to 3. And I think at that point, the committee will have to make a judgment, but if it sees progress on inflation, then it's shown in the SEP projections, they think they can be adjusting rates downward. But I don't think they have to get all the way to 2 before you see those adjustments.
If we look at where we are with our start and the calculations that people like you make up to see what the path is forward, there are other ways within the system to be more restrictive. And of course one of them is...
So good to see familiar faces in the chat. Reckless Danny, Ian, Mr. Got Plenty. You guys were literally around when this channel was tiny. I mean, still tiny. But like literally tiny. You guys are proper OGs, always tuning into the videos, dropping a comment, hitting a like. I appreciate you guys. I appreciate you guys and your support. Look, the reality is we're posting content that matters, okay, which doesn't resonate with bubblegum viewers, right? People just want to jump in, make a quick buck. They're not watching this. They're not watching. How do they know what jobs figures are, inflation, PCE, CPI? No, they just want to go price go up, price go down, right? Simple, right? That's all they want. They want, oh no, Bitcoin's going to $1 million right now. It's hard because what we're trying to do here in this community is educate people. Yes, we want to bring them in. We understand they might be buying a Pepe. They might be just watching some TA video update on Bitcoin. We'll try to accommodate that. But it's also important to understand that, look, these things matter. And if you want to build pragmatic, sustainable wealth in crypto, long term, you're not just trying to be here for a minute. You're trying to make money and hold money and continue to make money over many years. Then you've got to learn the recipes, right? You've got to learn what moves the markets. And that's what this stuff is. Why do you think, like, why is everyone watching Jerome Powell right now? All the suits, why are they watching them? Right? But we think, oh, suddenly we're going to hit $1 million overnight by jumping into some meme coin. Like, maybe it happens. It's not the pragmatic way of building wealth. It's not sustainable. Even if you made $1 million tomorrow on Pepe, what's to say you won't lose it within 6 months? Because you haven't leveled up mentally. You haven't leveled up your brain to say, you know what? Take my money. I can make it back again in another 3 years, 4 years, 5 years. Right? That's where you want to get to. That's where you want to get to. You want to solve the puzzle that is money. Right? You want to solve that puzzle. You don't want to get lucky. Getting lucky helps you today, doesn't help you tomorrow. Okay, Chris Locke, the same thinking live, Ijaz for real. Appreciate you, buddy. Do you think Dot and Kusama are still relevant? Yes, I just think they've got a lot more to do. They've got a lot more to do. They need to get cracking, and they need to take advantage of this next cycle. If they don't, problems. Matic from Start With You, Ijaz legend. You're the legend, buddy. I really appreciate you guys for digging in. Like, that's what I respect about you guys. Not about this channel or me. Like, you went to dig to find out knowledge. Like, I gotta rate that. If you guys are actually coming to watch this channel instead of a channel with a Bugatti on the front and saying, oh look, I bought this Bugatti with crypto. Like, fine, that's great. Show your Bugatti if you're gonna show the substance behind it. If you're just showing your car and then after that you're not showing any substance, like, how are you helping people? Right? Help them. Right? Millionaires, billionaires, they're watching FOMC, they know what PCE is, they know what CPI is, they know what inflation is, they manage their wealth, they build portfolios, they risk manage. These things are for real. They're not made up. They're not made up, are they? If you were to take 1 million, find a bunch of millionaires and do a sample size of them, right? How many of them are going to go, oh, I bought a meme coin and suddenly became a millionaire? No. Quick money, you make easy come, easy go, right? You've heard that saying before. Music Edition wants to give a shout out to Phantom. They don't need a shout out. They scammers already had money, says Reckless. Atu says great stuff. Thanks for the info and preview, Shoaib. Good to see you. Says Phantom is skyrocketing. I mean, it's doing better than other projects at the moment, up 2%. And you're seeing this anytime there's a little bit of movement on Bitcoin. Phantom is like a desperate horse waiting to get out of the blocks, right? And that's good. That's what you want your altcoins to be doing. You don't want them dead laying there. Even if Bitcoin has a positive day, they're not moving as well. That's not a great coin to be in. Phantom pushing up here, 42.5 cents, trying to get a nice move up here on the 1 minute chart.
First Republic, they held a lot of mortgages. Mortgages get hurt when rates go up. In the case of SVB, they held a lot of securities, and so I think banks do maturity transformation. They borrow short and lend long, and when bond yields go up a lot, some banks are going to be challenged, and so I just think it's an inevitable part of monetary policy. As I said, the banking system as a whole is sound, but banks that have big exposure to rising rates that they didn't hedge are not surprisingly going to get hurt.
And I can ask you this because you're the monetary guy. If you're the regulation guy, I couldn't ask you this stuff.
Okay, I just need to cover this off because I still think a lot of people don't actually know what the banking crisis is. We went through this initially when it all happened with Silicon Valley Bank and Signature Bank. But just a quick TLDR for you guys. Why do interest rates affect these banks? Very quickly. So when the interest rates go up, that means the yield on your bond goes up. And so banks are sitting on all these bonds where the yields have gone up, which is fantastic. But you need to understand that if a yield is 6, 7, 8, 9, 10% on a government bond, the price is inversely correlated to it. That's the way the bond mechanics work. Now we can get into that in a separate video if you guys want. It'll be a really boring video. But then the yield goes up, price of the bond goes down. So on your balance sheet as a bank, you have a bond which theoretically, once you get paid all your interest, your coupons from the bond, you're going to get a lot of money. but on face value, it's worth no. Hopefully this makes sense. So if you had $1 million of a bond, but the yield went up, the $1 million in face value would drop down to, let's say, 900,000 or 800,000. And that 800,000 is what you're showing on your balance sheet. Even though you think in your brain, which rightly so, is like it's $1 million because I'm going to get all these coupon payments in the next 3, 4, 5 years, and therefore it's fine. But guess what? Guess when it does matter is when people have a run on the bank. If people want to take their money out of the bank, they go, hey, give me my cash. But the bank goes, I've only got 800,000. I've not got your $1 million of cash. There's the problem. That's a bank run, okay? They become insolvent. Signature Valley Bank, Signature Bank, same thing. First Republic, okay? This is why they don't want Jerome Powell to increase rates. Every time he increases rates, the face value of the bonds go down, the balance sheet deteriorates. And we don't know how many of the banks right now are in that precarious position where one more 25 base points like the one we had today or another one at the next meeting could be the straw that breaks the camel's back for them. We don't know how many there are. Maybe Jerome Powell knows. They're certainly not telling us. They're just saying, oh, banks are working fine. No, right? There's no smoke without fire. So you think, oh, 3 banks suddenly collapse. Some of the biggest banks, some of the biggest banking collapse of all time for the US. And suddenly, oh no, the rest are fine. They were just poorly managed, right? What, when the rest were all angels? Nah, guys, look beyond that, okay?
I think I'll just leave my answer at that. Obviously, I've not been in the building for 15 months, and I'll just leave my answer at that.
All right. Well, just to give you a sense.
Show to a pause.
Well, Rich, the reason why this is important is because people often think of these as independent items, right? You've got on one hand policy, and you definitely have an inflation problem. But John, you have to wonder.
Okay, so Ian's asking me about Render. Long term, another project I like, right? Render is a good project. I think I like being in the picks and shovels. If people are going to need GPU processing, I want to be in the platform that's doing that, right? Picks and shovels in an early industry, in a nascent industry, is a good way of playing things, right? Look for the picks and shovels. And then what you want to look for is it coming to support? And the answer is yes. Here on the daily chart, it came into its EMA ribbon. So again, as part of your DCA strategy, if you can predominantly focus on trying to buy in these areas, it will do you well to buy in the EMA ribbon. Try to wait for those pullbacks. Now, longer term, where do I expect this to go? Well, use the weekly chart. Look at my Fibonacci ratios I've got drawn on. I'm not changing them at all. Right? Very comfortable. I expect this to get back to its 0.6 to 0.65, 0.618 to 0.65. That's the golden pocket in here. Again, we go through this, ijaz.uk/TA. If it doesn't make sense to you, check it there. I expect it to get back to $5.50 to $5.80. But really, the more exciting thing is getting back to all-time high, okay, getting back to the $8.70 mark, and then working its way to $14 on the Fibonacci golden ratio. Nice risk to return. You're looking at a 7x just to get to this level here. Not too shabby whatsoever here on Render. I like the project, but again, it's a smaller project, and I wouldn't want to go crazy in it. But you did see the run-up it had, right? It did particularly well in a very, very difficult period throughout last year. Okay, Mr. Got Plenty, thank you for the super chat. When asked if ETH is a security, Gary Gensler said it depends when you look at ETH. Staked ETH, wrapped ETH, synthetic ETH, and all the various forms. Is he correct when he says it depends? Shout out to IA Crypto. Okay, appreciate you, Mr. God Eve. You are one of those OG guys, so I appreciate you supporting the channel. Okay, so first of all, don't listen to anything Gary Gensler says, right? He sways his mood with the ocean, with the tide. We wait on one day, and based on who's put money in his pocket, he changes his opinion, right? That seems to be what we're seeing here from the SEC, right? No clarity whatsoever. But the other important thing is to understand, a security is something which is not a commodity, right? The opposite is a commodity. So if you think about a commodity, it's something which anybody can have, right? So you can think about a commodity being oil, you can think about a commodity being gold, you can think about a commodity being anything which is, silver, something of substance, which is why Bitcoin has been so clear that everyone goes, look, Bitcoin is the digital gold, right? Fine, straightforward. Now, where it gets confusing is when ETH becomes an asset, or any layer 1 solution or platform like this becomes an asset, which is tied to more of an organizational structure, right? If it's like buying Apple shares, or if it's like, because I can say to you guys, go buy some wood and build a treehouse in your garden. That's not me giving you financial advice, is it? Surely not, right? But wood is a commodity. What if the price of wood goes up? Could it be a security? You see what I mean? Whereas I can't say to you guys, go buy Apple stock. That's financial advice. You see the difference? And so that's where you end up being in this really tricky situation where if somebody says buy ETH, is that you buying like wood? Is it like just saying to your friend, go buy some wood? You might have fun with it? Or is it like telling someone, go buy some shares of Apple or Microsoft because you're going to make money, right? That's the battle going on, and it's very, very complicated. Shoaib wants to look at the Phantom Fibonacci chart. Of course I can do that for you, sir. Let's just pull that up. Boom! Phantom Fibonacci chart, same thing, right? Hovering around still at the bottom here, guys. We've got so much potential here on these projects. Even without going back to all-time high, there were so many explosive returns to be had. And that's the fun of persevering through this bear market, DCing at some of these low points. You're going to get amazing returns just to get back to levels we've been at already. Imagine that. Imagine getting to a point you've been at, this level here, and your bag's just looking so green. And then you get to all-time highs and your bag's even more green. And that's where this is the starting line. That's what's crazy. This right here is the starting line. This is where we just need to do this. We just do that in the project and you've done your research. You shouldn't be like, I don't think it's going to be the same. Now, what I just said there, would I say the same for Solana? Absolutely not. Right? And that's what's called conviction changing. The conviction changing is like, I don't think Solana can just go back to its all-time highs. No, things have fundamentally changed. Really important to have that kind of conviction.
Point down in Washington, D.C.
How much is the debt ceiling debate tightening financial conditions in the very short end and making the job even more difficult around regional banking, because you're seeing those 3-month T-bill yields at the highest levels now, going back to 2001? Is this because of monetary policy? I don't think so. I think this is a debt ceiling disruption kind of issue.
Also, if you get the kind of spending cuts that the Republicans would like to see, Tom, you've got to factor that into your projections at some point as well.
Right, guys, we're going to switch over to Jerome Powell. Again, I'm going to try to shut up so you guys can listen to Jerome Powell. I'll weigh in if there is anything I think I need to add in terms of context, but I don't like interrupting too much so you guys can listen to him. Again, a lot of the questions are going to be pre-prepared, right? There's going to be a lot of pre-prepared questions, a lot of dodging, a lot of political stuff, but we're listening out for, is he hawkish? Is he dovish? Try to gauge the whole tone. Does he give us any clues about, will we get a pause? Will he give us clues that no, he's going to hike again? That's what we want to listen to. Okay, very, very important. So we'll tune over to that. Now, if the audio goes off, you need to tell me. Again, maybe have it set up on another device or something on YouTube so you can listen into it on there if this is lagging. But hopefully we're good just to get through this press conference. And I promise next time I'll be back in my studio so we don't have to put up with this rubbish. Pepe is down 8% today. Let's drop it down to the hourly. And you're seeing a big bounce here on the hourly chart on Pepe. In fact, if we drop it down to the 5-minute, you're seeing it's happening over the last few minute charts. A lot of people saying, oh, why am I covering Pepe? Guys, because it's fun. It's fun. Live a little, right? I use the analogy of, can a football player not play a game with his friends sometimes? Yeah, of course he can, right? Most of my investing is so serious, so methodical, right? All that stuff. That sometimes you do want to have fun. It's okay to have fun and buy some meme coins, right? Play around meme coins. So what? As long as you eat your veg and you're buying your Bitcoin and Ethereum, you're managing your risk, do what you want. If Pepe is a way for people to come into crypto, fantastic. Because guess what? Once the Pepe hype dies down, people will make money and people will lose money. But then guess what? They'll start learning about Bitcoin. They'll start learning about Ethereum. They'll start learning about other projects. Right? They'll be part of this community to learn. And we will accept them. We don't want to be the people that say, oh no, don't invest in Pepe. It's a scam. It's a scam. It's a scam. If we've got evidence it's a scam, of course we'll then say it's a scam. Right? But for now, it's just a social coin. It's a meme coin. And Jerome Powell is walking.
Hiking interest rates by 25 basis points. Let's listen in.
Good afternoon. Before discussing today's meeting, let me comment briefly on recent developments in the banking sector. Conditions in that sector have broadly improved since early March, and the U.S. banking system is sound and resilient. We will continue to monitor conditions in the sector. We're committed to learning the right lessons from this episode and will work to prevent events like these from happening again. As a first step in that process, last week we released Vice Chair for Supervision Barr's review of the Federal Reserve's supervision and regulation of Silicon Valley Bank. The review's findings underscore the need to address our rules and supervisory practices to make for a stronger and more resilient banking system, and I'm confident that we will do so. From the perspective of monetary policy, our focus remains squarely on our dual mandate to promote maximum employment and stable prices for the American people. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by a 0.25 percentage point. Since early last year, we've raised interest rates by a total of 5 percentage points in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are also continuing to reduce our securities holdings. Looking ahead, we'll take a data-dependent approach in determining the extent to which additional policy firming may be appropriate. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The first quarter of this year continued to be modest at 1.1%, despite a pickup in consumer spending. Activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the first 3 months of the year, job gains averaged 345,000 jobs per month. The unemployment rate remained very low in March at 3.5%. Even so, there are some signs that supply and demand in the labor market are coming back into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. But overall, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in March, total PCE prices rose 4.2%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a 0.25 percentage point, bringing the target range to 5 to 5.25%. And we're continuing the process of significantly reducing our securities holdings. With today's action, we have raised interest rates by 5 percentage points in a little more than a year. We are seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In addition, the economy is likely to face further headwinds from tighter credit conditions. Credit conditions had already been tightening over the past year or so in response to our policy actions and a softer economic outlook. But the strains that emerged in the banking sector in early March appear to be resulting in even tighter credit conditions for households and businesses. In turn, these tighter credit conditions are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of these uncertain headwinds, along with monetary policy restraint we've put in place, our future policy actions will depend on how events unfold. In determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will make that determination meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we are prepared to do more if greater monetary policy restraint is warranted. We remain committed to bringing inflation back down to our 2% goal and to keep our longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thanks, Gina.
Hi, Gina Smilik, New York Times. Thanks for taking our questions. I wonder if you could tell us whether we should read the statement today as a suggestion that the committee is prepared to pause interest rate increases in June. And I also wonder if the Fed staff has in any way revised their forecast for a mild recession from the March minutes. And if so, what a recession like what they're envisioning would look and feel like when it comes to, for example, the unemployment rate.
So, taking your question, of course, today our decision was to raise the federal funds rate by 25 basis points. A decision on a pause was not made today. You will have noticed that in the statement from March, we had a sentence that said the committee anticipates that some additional policy firming may be appropriate. That sentence is not in the statement anymore. We took that out, and instead we're saying that in determining the extent to which additional policy firming may be appropriate to return inflation to 2% over.
We spotted that straight away, guys. That change in that sentence, that's good. That's a good sign.
That's a meaningful change that we're no longer saying that we anticipate. And so we'll be driven by incoming data, meeting by meeting, and we'll approach that question at the June meeting. So the staff's forecast is so. Let me start by saying that that's not my own most likely case, which is really that the economy will continue to grow at a modest rate this year, and I think that's so. Different people in the committee have different forecasts. That's my own assessment of the most likely path. Staff produces its own forecast, and it's independent of the forecasts of the participants, which include the governors and the Reserve Bank presidents, of course. And we think this is a healthy thing, that the staff is writing down what they really think. They're not especially influenced by what the governors think, and vice versa. The governors are not taking what the staff says and just writing that down. So it's actually good that the staff and individual participants can have different perspectives. So broadly, the forecast was for a mild recession, and by that I would characterize as one in which the rise in unemployment is smaller than has been typical in modern era recessions. I wouldn't want to characterize the staff's forecast for this meeting. We'll leave that to the minutes, but broadly similar to that.
Rachel.
Thank you, Chair Powell. Rachel Siegel from The Washington Post. Thanks for taking our questions. I'm wondering if you can talk about the account of possible effects of a debt limit standoff. You've said repeatedly that the ceiling must be raised, but do you see any economics effects of even getting close to a default, and what type of situation would that look like?
So I wouldn't want to speculate specifically, but I will say this. These are fiscal policy matters, for starters, and they're for Congress and the administration, for the elected parts of the government to deal with, and they're really consigned to them. From our standpoint, I would just say this. It's essential that the debt ceiling be raised in a timely way so that the U.S. government can pay all of its bills when they're due. A failure to do that would be unprecedented. We'd be in uncharted territory, and the consequences to the U.S. economy would be highly uncertain and could be quite averse. So I'll just leave it there. We don't give advice to either side. We just would point out that it's very important that this be done. And the other point I'll make about that, though, is that no one should assume that the Fed can protect the economy from the potential, short and long-term effects of a failure to pay our bills on time. It would be so uncertain that it's just as important that we never get to a place where we're actually talking about or even having a situation where the U.S. government's not paying its bills.
And just to follow up, was discussion around the uncertainty of a possible standoff, did that affect today's monetary policy decision at all?
I wouldn't say that it did. It was, of course, it's something that came up. We talk a lot about risks to the outlook, and that come up. A number of people did raise that as a risk to the outlook. I wouldn't say that it was important in today's monetary policy decision yet.
Steve.
Mr. Chairman. Thank you. Steve Leisman, CNBC. Can you tell us what the Federal Reserve Board did in the wake of that February presentation where you were informed that Silicon Valley Bank and other banks were experiencing interest rate risks? And can you tell me what supervisory actions you've done in the wake of the recent bank failures to make sure that banks are currently appropriately managing interest rate risk? And kind of part three, but it's all the same question here. Do you still think this separation principle that monetary policy and supervision can be handled with different tools? Thank you.
Sure. So the February 14th presentation, I didn't remember it very well, but now, of course, I've gone back and looked at it very carefully. I did remember it. And what it was a general presentation. It was an informational briefing of the whole board, the entire board. I think all members were there. And it was about interest rate risk in the banks and lots of data. And there was one page on Silicon Valley Bank which talked about, the amount of losses mark-to-market losses they had in their portfolio. There was nothing in it about, that I recall anyway, about the risk of a bank run. So it was, I think the takeaway was they were going away to do an assessment, a horizontal making opportunity now, really since the events of early March to build liquidity. You asked about the separation principle. Like so many things, it's very useful. But, ultimately it has its limits. I mean, I think in this particular case, we have found that the monetary policy tools and the financial stability tools are not in conflict. They're working well together. We've used our financial stability tools to support banks through our lending facilities. And at the same time, we've been able to use our monetary policy tools to foster maximum employment and price stability.
Mr. Chairman, I'm sorry. I don't mean to be argumentative, but the staff report said SVB has significant interest rate risk. It said interest rate risk measurements failed at SVB, and it said banks with large unrealized losses face significant safety and soundness risk. Why was that not alarming?
Well, I mean, I didn't say it wasn't alarming. It was they're pointing out something that they're working on and that they're on the case. That I'm not sure whether they mentioned. I think they did actually. They mentioned that they had taken regulatory action, or supervisory action in the form of matters requiring attention. So I think that was also in the presentation. I think it was to say, yes, this is a bank, and there are many other banks that are experiencing these things, and we're on the case.
Thank you.
Go to Victoria.
Hi, Chair Powell. I wanted to ask you, obviously, with the recent bank turmoil, we've seen multiple banks buy other banks. And I was just curious whether you think that further consolidation in the banking sector would increase or decrease financial stability, and whether you have any concerns about the biggest bank in the U.S. Getting even larger.
So, we certainly don't, and I don't have an agenda to further consolidate banks. Consolidation has been a factor in the U.S. banking industry really since interstate banking, and before that even. It goes back more than 30 years. When I was in the government a while back, I think there were 14,000 banks. Now there are 4,000 and change. So that's going on. I personally have long felt that having small, medium, and large-sized banks is a great part of our banking system. The community banks serve particular customers very well. Regional banks serve very important purposes, and the various kinds of GSIBs do as well. So I think it's healthy to have a range of different kinds of banks doing different things. I think that's a positive thing. Is it a financial? So I would just say, in terms of J.P. Morgan buying First Republic, the FDIC really runs the process of closing and selling a closed bank completely. That is their role, so I really don't have a comment on that process. As you know, there's an exception to the deposit cap for a failing bank. So it was legitimate, and I think the FDIC, I believe, is bound by law to take the bid that is the least cost bid. So I would assume that's what they did.
So, but do you have any concerns about the fact that they're getting larger in general?
So I think it's probably good policy that we don't want the largest banks doing big acquisitions. That is the policy, and but this is an exception for a failing bank, and I think it's actually a good outcome for the banking system. It also would have been a good outcome for the banking system had one of the regional banks bought this company, and that could have been the outcome. But ultimately, we have to follow the law in our agencies, and the law is it goes to the least cost bid.
Colby. Thank you. Colby Smith with the Financial Times. At the March meeting, you mentioned that a tightening of credit conditions from the recent bank stress could be equal to one or more rate increases. So given developments since then, how has your estimate changed?
Yeah, I think I followed that up by saying it's quite impossible to have a precise estimate of the words to that effect. But in principle, that's the idea. You know, when we've been raising interest rates, and that raises the price of credit, and that, in a sense, restricts credit in the economy, working through the price mechanism. And you know, when banks raise their credit standards, that can also make credit tighter in a kind of broadly similar way. It isn't possible to make a kind of clean translation between one and the other, although firms are trying that, and you know, we're trying it. But ultimately, we have to be honest and humble about our ability to make a precise assessment. So it does complicate the task of achieving, you know, a sufficiently restrictive stance. But I think conceptually, though, we think that interest rates, in principle, we won't have to raise rates quite as high as we would have had this not happened. The extent of that is so hard to predict because we don't know how persistent these effects will be. We don't know how large they'll be and how long they'll take to be transmitted. But that's what we'll be watching carefully to find out.
Just to quickly follow up, what does it suggest about the scope for the committee to pause rate increases perhaps as early as next month, even if the data remains strong then, if it's having some kind of substitute effect?
This is just something that we have to factor in as we want to find ourselves. So I guess I would say it this way. The assessment of the extent to which additional policy firming may be appropriate is going to be an ongoing one, meeting by meeting, and we're going to be looking at the factors that I mentioned that are listed in the statement, the obvious factors. That's the way we're going to be thinking about it. That's really all we can do. As I say, it does complicate. We have, a broad understanding of monetary policy. Credit tightening is a different thing. There's a lot of literature on that, but translating it into rate hikes is uncertain. Let's say it adds even further uncertainty. Nonetheless, we'll be able to see what's happening with credit conditions, what's happening with lending. There's a lot of data on that, and we'll factor that into our decision making.
Howard.
Howard Schneider with Reuters. Thank you. So noting that the statement dropped the reference to sufficiently restrictive, I was wondering, given your baseline outlook, whether you feel this current rate of 5 to 5.25% is in fact sufficiently restrictive.
So that's going to be an ongoing assessment. We're going to need data to accumulate on that. Not an assessment that we've made. That would mean we think we've reached that point, and I just think it's not possible to say that with confidence now. But nonetheless, you will know that the summary of economic projections from the March meeting showed that at that point in time that the median participant thought that this was the appropriate level of the ultimate high level of rates. We don't know that. We'll revisit that at the June meeting, and that's we're just going to have to, before we really declare that, I think we're going to have to see data accumulating and and make that, as I mentioned, it's an ongoing assessment.
And a follow-up on credit, if I could. Could you give us a sense of what the SLOOS survey indicated? It was already, I think 45% of banks were tightening credit as of the last survey. What did this one show, and how did that weigh into your deliberations?
So we're going to release the results of the SLOOS on May 8th, in line with our usual time frame. And I would just say that the SLOOS is broadly consistent when you see it with how we and others have been thinking about the situation and what we're seeing from other sources. You will have seen the Beige Book and listened to the various earnings calls that indicate that mid-sized banks some of them have been tightening their lending standards. Banking data will show that lending has continued to grow, but the pace has been slowing really since the second half of last year.
Let's go to Nick.
Nick Tamaros of the Wall Street Journal. Chair Powell, the argument around the end of last year and the beginning of this year to slow down the pace of increases was to give yourself time to study the effects of those moves. After the bank failures in March, as you've discussed, the Fed staff projected a recession starting later this year. So my question is why it was necessary to raise interest rates today, or put differently, if the whole point of slowing down the pace was to see the effects of your moves, and now you've, for the last two meetings, been seeing the effects of those moves. Why did the committee feel it was necessary to keep moving?
Well, the reason is that again, with our monetary policy, we're trying to reach and then stay at for an extended period, a level of policy stance that's sufficiently restrictive to bring inflation down to 2% over time, and that's what we're trying to do with our tool. I think slowing down was the right move. I think it's enabled us to see more data, and it will continue to do so. So we really, we have to balance. We always have to balance the risk of not doing enough and not getting inflation under control against the risk of maybe slowing down economic activity too much. And we thought that this rate hike, along with the meaningful change in our policy statement, was the right way to balance that.
And just to follow up, what you said in response to Howard's question, you'll need data to accumulate to determine if this is a sufficiently restrictive stance. Does that data need to accumulate, or could it accumulate over a longer period than a 6-week intermeeting cycle?
As I mentioned, I would just say that this assessment will be an ongoing one. You can't, with economic data, you can't. You've seen, take inflation from it. Look back. We've seen inflation come down, move back up 2 or 3 times since March of 2021. We've seen inflation have a few months of coming down and then come right back up. So I think you're going to want to see that, that a few months of data will persuade you that you've got this right, kind of thing. And we have the luxury. We've raised.
Keep in mind, guys, you're going to get 2 readings before the next meeting. Next meeting is on June the 14th. We're getting 1 reading next week on the 10th of May, and then you're getting 1 the day before, I believe, the next FOMC meeting, so June the 13th, roughly. So he's going to get armed with that. He's got the non-farm payrolls on Friday as well.
2% real rates. That's meaningfully above what many people anyway, would assess as the neutral rate. So policy is tight, and you see that in interest-sensitive activities, and you also begin to see it more and more in other activities. And if you put the credit tightening on top of that and the QT that's ongoing, I think you feel like we may not be far off, or possibly even at that level.
Thank you very much, Chair Powell. Edward Lawrence with Fox Business. So if the Federal Reserve gets down to the 3% inflation, as the projections show at the end of this year, or close to it, would it be okay for you for a prolonged period of 3% inflation and hoping for some outside event to move down to 2% target?
I think we're always going to have 2% as our target. We're always going to be focusing on getting there.
But would you be okay with a prolonged 3%?
Let me just say that's not what we're looking for. We're looking for inflation going down to 2% over time. I mean, That's not a question that's in front of us, and it would depend on so many other things. But ultimately, we're not looking to get to 3% and then drop our tools. We have a goal of getting to 2%. We think it's going to take some time. We don't think it'll be a smooth process. And I think we're going to need to stay at this for a while.
How does the other side of the mandate, the jobs side, once you get to 3%, going from 3 to 2, how does the other side of the mandate balance?
I think they will both matter equally at that point. Right now, you have a labor market that's still extraordinarily tight. You've still got 1.6 job openings, even with the lower job openings number, for every unemployed person. We do see some evidence of softening in labor market conditions, but overall, you're near a 50-year low in unemployment. Wages, you all will have seen the wage number from late last week, and it's whenever it was, and it's a couple percentage points above what would be consistent with 2% inflation over time. So we do see some softening. We see new labor supply coming in. These are very positive developments, but the labor market is very, very strong. Whereas inflation is running high, well above our goal, and right now we need to be focusing on bringing inflation down. Fortunately, we've been able to do that so far without unemployment going up.
Matt. Hi, Chair Powell. Matthew Boesler with Bloomberg News. So many analysts noted at the time of the March FOMC meeting that at least half of Fed officials' projections did imply or seem to imply that a recession was in their baseline forecast as well, given the strong first quarter GDP tracking estimates. And so I'm just wondering if you could kind of elaborate on, why you're optimistic that a recession can be avoided, given that that's the Fed staff's forecast, possibly also the broader committee's forecast as well, and also, of course, most private sector forecasters.
Yeah, I don't think, I know what's printed in the Summary of Economic Projections and all that. I don't think you can deduce exactly what you said about what participants think, because you don't know what they were thinking for first quarter GDP at that point. They could have been thinking about a fairly low number. Anyway, in any case, I'll just say I continue to think that it's possible that this time is really different. And the reason is there's just so much excess demand, really, in the labor market. It's interesting, as we've raised rates by 5 percentage points in 14 months, and the unemployment rate is 3.5%, pretty much where it was, even lower than where it was when we started. So job openings are still very, very high. We see by surveys and much evidence that conditions are cooling gradually, but it really is different. It wasn't supposed to be possible for job openings to decline by as much as they've declined without unemployment going up. Well, that's what we've seen. So there are no promises in this, but it just seems to me that it's possible that we can continue to have a cooling in the labor market without having the big increases in unemployment that have gone with many, prior episodes. Now, that would be against history. I fully appreciate that. That would be against the pattern. But I do think that the situation in the labor market with so much excess demand, yet wages have been moving down. Wage increases have been moving down, and that's a good sign, down to more sustainable levels. So I think it's still possible. I think the case of avoiding a recession is, in my view, more likely than that of having a recession. But it's not that the case of having a recession is. I don't rule that out either. It's possible that we will have what I hope would be a mild recession.
The committee also noted in March that wage growth was still well above levels that would be consistent with 2% inflation. Do you see that as well? And could you kind of explain, how you come to that judgment?
Sure. So we look at a range of wage measures, and then that's a nominal. And then so you assume wages should be equal to productivity increases plus inflation. And so you can look at the Employment Compensation Index, average hourly earnings, the Atlanta Wage Tracker, compensation per hour, basically those four, and many others, and you can look at what they would have to run at over a long period of time for that to be consistent with 2% inflation. They can deviate. Corporate margins can go up and down, and there is a feature of long expansions where they do go down, where labor gets a bigger share toward later in a recession. later in expansion. So, yeah, and we calculate those, and you have to take the precision with a degree of salt. But I would say that what they will show is that, if wages are running at 5%, 3% is closer to where they need to be. Wage increases closer to 3%, roughly, is what it would take to be consistent with inflation over a longer period of time. By the way, I do not think that wages are the principal driver of inflation. You're asking me a very specific question. I think there are many things. I think wages and prices tend to move together, and it's very hard to say what's causing what. But I've never said that, that wages are really the principal driver, because I don't think that's really right.
Great. Chris Rugaber at Associated Press. Well, you mentioned profit margins. Those have did expand sharply during this inflationary period. And while there are some signs that they are starting to decline, many economists note they haven't fallen as much as might be expected, given that we're seeing at least some pullback among consumer spending. So, speaking of causes of inflation, do you see expanded profit margins as a driver of higher prices? And if so, would you expect them to narrow soon and contribute to reduced inflation in the coming months?
So higher profits and higher margins are what happens when you have an imbalance between supply and demand. Too much demand, not enough supply. And we've been in a situation in many parts of the economy where supply has been fixed or not flexible enough. And so, the way the market clears is through higher prices. So I think as goods pipelines have gotten, back to normal, so that we don't have the long waits and the shortages and that kind of thing, I think you will see inflation come down, and you'll see corporate margins coming down as a result of a return of full competition, where there's enough supply to meet demand, and then you're really back to full competition. That would be the dynamic I would expect.
Michael McKee from Bloomberg Radio and Television. Can you tell us something about what your policy reaction function is, your policy framework is going forward? When you look at the economy at the next meeting, are you looking at incoming data, which is by definition backward looking? Are you going to be forecasting what you think is going to happen? Are you ruling out the rate cuts that the market has priced in?
I didn't catch the last part. Ruling.
Markets have priced in rate cuts by the end of the year. Do you rule that out?
Okay, I got it. So what are we looking at? I mean, we look at a combination of data and forecasts. Of course, the whole idea is to create a good forecast based on what you see in the data. So we're always looking at both, and it'll be the obvious things. It'll be readings on inflation. It'll be readings on wages, on economic growth, on the labor market, and all of those many things. I think a particular focus for us going now over the past 6-7 weeks now, and going forward, is going to be what's happening with credit tightening. Are small and medium-sized banks tightening credit standards, and is that having an effect on loans, on lending? And so we can begin to assess how that fits in with monetary policy. That'll be an important thing. We'll be looking at everything. I would just point out, we've raised rates by 5 percentage points. We are shrinking the balance sheet, and now we have credit conditions tightening, not just in the normal way, but perhaps a little bit more due to what's happened. And we have to factor all of that in and make our assessment of whether our policy stance is sufficiently restrictive. And we have to do that in a world where policy works with long and variable lags. So this is challenging, but we will make our best assessment, and that's what we'll be thinking.
What about the idea of rate cuts?
Yeah, so we on the committee have a view that inflation is going to come down, not so quickly, but it'll take some time. And in that world, if that forecast is broadly right, it would not be appropriate to cut rates, and we won't cut rates. If you have a different forecast, then markets have been from time to time pricing in quite rapid reductions in inflation. we'd factor that in, but that's not our forecast. And of course, the history of the last 2 years has been very much that inflation moves down, particularly now if you look at non-housing services. It really hasn't moved much, and it's quite stable. And so we think we'll have to demand will have to weaken a little bit, and labor market conditions may have to soften a bit more to begin to see progress there. And again, in that world, it wouldn't be appropriate for us to cut rates.
Courtney? Courtney Brown from Axios. I'm curious how you view the role of the overnight reverse repo facility in the context of the current banking stress. Do you think it's contributing to the stress by
So it's very interesting, right? If you look at the price action here, guys, you can see Bitcoin straight away started downtrending, right? Bitcoin just started downtrending. The vertical line is when the announcement happened. But then the NASDAQ is doing a bit of a diamond pattern here. It's kind of really sideways right now, not picking a direction either way. So Bitcoin just slightly here, nudging to the downside. Not a crazy volatile press conference so far, because the 25 base points was expected, and pretty much, just waiting to hear, was he going to be dovish, was he going to be hawkish? He's kind of in the middle. I wouldn't say he's too hawkish. I wouldn't say he was dovish either. But the big takeaway is not listening to what they say, but what they actually do. And the biggest takeaway we've got is that him taking out that statement that normally he has ongoing rate hikes. I think that's the biggest thing so far. So let's hear the end of this conference now. We'll do a wrap-up video separately for you guys as I reflect on what he says.
Of maybe the last year, retail investors had been gradually, as they do in every tightening cycle, they've been gradually moving their deposits into higher yielding places such as CDs and other things, including money market funds. So that's a gradual process that is quite natural and happens during a tightening cycle. What was unusual really was the institutional investors moving their uninsured deposits and spreading them around and things like that. But it doesn't seem to have had any effect overall on over the overnight repo facility. That is really there to help us keep rates where they're supposed to be, and it's serving that purpose very well.
Okay, Sarah. Sarah Ewald-Weiss, CBS News. I want to go back to the debt ceiling for a moment. I know you talked about that in terms of fiscal policy, but can you just speak towards what the impact of a default would mean for Americans across the country, the markets, and borrowing?
Yeah, I would just say it's. I don't really think we shouldn't even be talking about a world in which the U.S. doesn't pay its bills. It just shouldn't be a thing. And again, I would just say no one should assume that the Fed can really protect the economy and the financial system and our reputation globally from the damage that such an event might inflict.
Scott.
Thanks, Mr. Chairman. Scott Horsley from NPR. In his report last week, Vice Chair Barr identified a couple of the factors that he thought contributed to the regulatory or the supervisory lapses at Silicon Valley Bank. A policy change in 2019 to exempt all but the biggest banks from strict scrutiny, and also what he called a sort of cultural shift towards less aggressive oversight. You were here in 2019. Do you share that view, and what would it take to get the stronger oversight that you and he said in your release would be necessary?
So I didn't take part in creating the report or doing the work, but I have read it, of course, and I find it persuasive. I mean, I would say it this way: a large bank, not a very large bank, a large bank failed quite suddenly and unexpectedly in a way that threatened to spread contagion into the financial system. I think the only thing that I'm really focused on is to understand what went wrong, what happened, and identify what we need to do to address that. Some of that may just have been technology evolving. We have to keep up with all that, but some of it may be our policies and supervisory and regulatory, whatever. Well, what our job is now is to identify those things and implement them, and that's kind of the only thing I care about and I feel like I am accountable for doing everything I can to make sure that happens.
Evan.
Thank you. Evan Reiser with MNI Market News. Chair Powell, are we in the early stage or nearing the end stage of the banking turmoil among regional banks? And secondly, do you still have a bias to tighten rates? Is that what the statement is saying?
So, I guess I would say it this way. There were three large banks, really, from the very beginning, that were at the heart of the stress that we saw in early March, the severe period of stress. Those have now all been resolved, and all the depositors have been protected. I think that the resolution and sale of First Republic kind of draws a line under that period of, is an important step toward drawing a line under that period of severe stress, okay? I also think we are very focused on what's happening with credit availability, particularly, with what you saw in the Beige Book, and you will see in the SLOOS, is small and medium-sized banks who are feeling that they need to tighten credit standards, build liquidity. What's going to be the macroeconomic effect of that? More broadly, an important way going forward.
Thank you, Fed Chairman. Greg Robb from MarketWatch. I just wondered if you've done any reflection on your own actions during this crisis and leading up to it over the since you've been Fed Chairman. I think I've heard you say a couple of times that you deferred to the Vice Chair for supervision. Do you think that was the right way to go about this? And comments on that. Thank you.
Sure. So let me say, first of all, I've been chair of the board for 5+ years now, and I fully recognize that we made mistakes. I think we've learned some new things as well, and we need to do better. And as I mentioned, I thought the report was unflinching and appropriately so. I welcome it, and I agree with and will support those recommendations. And I do feel that I'm personally accountable to do what I can to foster measures that will address the problems. So on the Vice Chair for supervision, the place to start is the statutory role, which is quite unusual. The Vice Chair, it says, shall develop policy recommendations for the board regarding supervision and regulation of depository institution companies, and shall oversee the supervision and regulation of such firms. So this is Congress establishing a 4-year term for someone else on the board, not the chair, as Vice Chair for supervision, who really gets to set the agenda for supervision and regulation for the Board of Governors. Congress wanted that person to have political accountability for developing that agenda. So the way it works, the way it has worked in practice for me is I've had a good working relationship. I give my counsel, my input privately, and I offer that, and I have good conversations, and I try to contribute constructively. I respect the authority that Congress has deferred on that person, including working with Vice Chair Barr and his predecessor. And I think that's the way it's supposed to work, and that's appropriate. I believe that's what the law requires, and but it isn't. I wouldn't say it's a matter of complete deference. It's more, I have a role in presenting my views and having an intelligent discussion about what's going on and why, and that's my input. But ultimately, that person does get to set the agenda and gets to take things to the Board of Governors, and really in supervision has sole authority over supervision.
Just wondered if you had any regrets, or was there anything that, decisions that maybe you regret now in light of what's happened?
I've had a few. Sure. I mean, who doesn't look back and think that you could have done things differently? But honestly, you don't get to do that. Again, my focus is on control the controllable. As one of my great mentors used to always say, control the controllable. What we control now is make a fair assessment, learn the right lessons, figure out what the fixes are, and implement them. And I think that Vice Chair Barr's report is an excellent first step in that, but we've got to follow through.
Great. Thank you. Hi there, Megan Casella with Barron's. Did the possibility of pausing at this meeting come up at all, and how seriously was that considered? I'm curious if you can give us any color as to whether there were any initial concerns about raising rates again, or what those discussions entailed.
Can you ask this at the beginning?
for the 25 basis point rate increase was very strong across the board. I would say there are a number of people, and you'll see this in the minutes. I don't want to try to do the head count in real time, but people did talk about pausing, but not so much at this meeting. There's a sense that we're much closer to the end of this than to the beginning. That, as I mentioned, if you add up all the tightening that's going on through various channels, we feel like we're getting close or maybe even there. But that's going to be an ongoing assessment, and we're going to be looking at those factors that we listed in to determine whether there's more to do.
I'm curious, too, how to interpret that and the changes to the statement. Is the bar higher now to raise rates at the next meeting, or would a strong jobs report or inflation print be enough to push the Fed to tighten again?
I don't want to. I couldn't really say assessment.
And we'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. You mentioned a few times about the lessons you learned from the banking crisis, that you would learn the right lessons. What are those lessons?
Well, I just would start with something that's changed, really, which is the run on Silicon Valley Bank was out of keeping with the speed of runs through history. And that now needs to be reflected in some way in regulation and in supervision. We know now that we know it's possible. I think no one thought that was possible. No one had. I'm not aware of anybody thinking that this could happen quite so quickly. So I think that that will play through. It will be up to Vice Chair Barr to really take the lead in designing the ways to address that. But I think that's one thing. I guess I would just say that. Then we're going to revisit. It's pretty clear to me anyway. It's clear that we need to strengthen both supervision and regulations for banks of this size, and I'm thinking that we're on track to do that as well.
Can you be any more specific on stress testing or looking at banks that have specific concentrations in certain parts of the economy?
Yeah, that's what Vice Chair Barr's role really is, and he'll take the lead on that.
Okay, thank you.
Thank you.
All right, Jerome Powell done. Guys, I will be doing a summary video. Thank you for joining me for this hour-and-a-half session with the most entertaining guy on the planet. No, not me, Jerome Powell. So, I will do a summary in a separate video. Make sure you go watch that. It'll be like 5-6 minutes. I'll just go for a walk and reflect on that. But I want to say congratulations, and I will say that in that video as well. Like, you've just been through one of the steepest rate hike cycles the US has ever seen. Right? And if you've navigated through that and you've done the right things, you've educated yourself, you've DCA'd, like, you've done that in a very difficult time. Loads of people have made a lot of money in easy times. When the government is printing, when stimulus checks are going out, when everything is going up and you can't get anything wrong. You've just done well navigating the steepest rate hike. And now, we're pretty much there. Right? Unless there's some unexpected drama in inflation, the US has done a good job. And I know a lot of people, particularly you guys sat in the US, may be thinking, oh no, he's doing a terrible job, Jerome Powell's not likable. Guys, come try UK, 10% inflation, try Europe, right? Germany's in trouble, Japan's in trouble. The US are actually doing alright. I know it sounds crazy, you're actually doing alright for now. So look, inflation's starting to come down in the right direction. We're sitting at 5 to 5.25% on the Fed funds rate. We could be at the end of this cycle, and that's a good sign. We're going to get our pause, stay there for a bit until inflation gets to 2.5%, then he can start cutting. And when he starts cutting, the money printer turns back on. Thanks for joining me, guys. I will do a summary. Do smash up the likes on